Good to have you back on the program. What do you think of this as Citi news? It doesn't surprise you, does it?
Well, what you're looking at in the United States is the worst revenue growth this year since 1938. You layer on top of that what's happening in Europe, and when Europe sneezes, the U.S. does catch cold, and you have weakness in capital markets. That combination results in the unfortunate situation where Citigroup and many banks simply have too much in expenses relative to their revenues, and it leads to job cuts. And I know how painful that is. I was fired in the year 2000, and I write about that in my book, Exile on Wall Street. And so it's a very difficult decision when companies decide to lay off employees.
Yeah, well, let me ask you then, Mike. 200,000 jobs so far, at least according to Bloomberg estimates, in 2011, which is still more than what the number of jobs lost in 2009. Does that surprise you?
None of this surprises me. The whole industry is late in controlling costs. And I'm not just talking personnel costs. I'm talking branch costs. I'm talking all sorts of overhead. And you know, our theme at CLSA for the United States has been that the United States is a lighter version of what's taken place in Japan. Capital markets have been weak for a couple quarters now, and I think, if anything, the surprise is that Citigroup and the industry at large has not moved more quickly to control their expenses and keep them in line with revenues. The efficiency of the United States banks is at the worst level in almost a decade. So, once again, the surprise is the banks haven't moved more quickly.
Yeah, well, you know, you heard Vikram Pandit. They're talking about unprecedented market conditions. Did that only come to light this year? Because you said they're behind the curve, right?
Well, you have a combination of factors. What is not new news is the revenue weakness. What's the new news is the degree of the weakness in the capital markets resulting from the European situation. So, as critical as I've been on Citigroup over the years and for some recent issues, I think the degree of the euro decline, I mean, not a whole lot of people saw this coming, you know, a couple quarters ago.
Well, yeah, that's true. Some people are now shorting the euro. But, okay, what about the exposure and the concerns about a banking crisis? What are your thoughts on these theories out there?
Well, the direct exposure of the big U.S. banks to Europe is very manageable. I mean, it's maybe $50 billion net, $75 billion gross. So based on the numbers that the banks have given us, at least on the U.S. side, it's okay. The issue is the second-order risk, and that's what we, as analysts, investors, tend to underestimate. How much do the big banks have loaned or invested to entities that are indirectly exposed to Europe, such as the case with MF Global? You saw in hindsight, while they are not located in the Euroland, that they were exposed to it. How many more MF Globals are out there? How many more hedge funds are out there? Many more entities are out there that cause the banks to be indirectly exposed to the region? And the other factor is simply the entire risk-off attitude. And that comes to not only with investors, but corporations and consumers, the loss of confidence related to the euro situation.
Right. Mike, I know you only cover U.S. banks, but do you have any thoughts as to the European banking system? For instance, you know, we had the story basically seeing that the Fed swaps, basically the dollar loans, the credit windows, they executed $50 billion in emergency loans last week, which is a peak for this year. Are you concerned that we're going to see a European bank go under in this crisis?
Well, CLSA has an amazing new report out today by our historian. I mean, how many firms have a historian? And it talks about nationalism capitalism. In other words, a retreat of capital back to the home markets. And so it's a very interesting report, and it raises concerns about whether the fiscal integration will actually occur. The leaders need to go back home and sell the plans back to their populations. That's one issue. Another issue is the firewalls. Are they strong enough? Many in the market were hoping for an ECB bazooka, where the ECB would buy back a lot of sovereign debt, monetize the debt, and take more aggressive action. And I think as we look at the situation, it might be one of deed over creed. Eventually, the leaders in Europe are going to look at the actions of the member states before perhaps taking more aggressive action. So it's still a wait-and-see situation.
Okay, gotcha, Mike. Thank you so much for your time. Always